Greetings, everyone. My name is Peter Young, and I, along with Federico Mannella, we're on the board of Societe de Chimie Industrielle, and I'm head of programs. And I'm going to turn it over to Federico, who is the moderator for this important event. But before I do that, I just want to say one or two things. We have some upcoming events that we would like to tell you about. So, for example, tomorrow, we have a Societe happy hour. No speeches. We just put everyone together and let them talk, and people love it. But you have to bring your own drink because it's virtual. And an invitation went out to everyone for that. Then on October 18th, we have a very interesting, as again, we do, chemicals and life sciences, and we're going to have one that should be of interest to everyone on October 18th at 12 o'clock. And there we have David Cole, who is the president of the Science History Institute that I was on the board of for a number of years, talk about the whole invention of DNA sequencing, the impact it's had on the drug and other industries, and what the future looks like. I think that's going to be an exciting one. That is both in person and virtual, and I think invitations have gone out for that. And the last one I want to point out is on November 15th, which also will be in person with some virtual, on a very interesting topic, which is digitization and how that's impacting the chemical industry. Very important topic because on so many different fronts, digitization, not just AI, is really becoming an important element of running your business. So I encourage you to attend any and all of those events. And if you forget the dates, just go to our events, the events section of the Societe website, or societe.org. And with that, I'm going to turn this over to Federico, and also hopefully make myself disappear from the screen.
Good afternoon and good morning to those of us who are still in that time zone. My name is Federico Mannella. I'm a managing director at DC Advisory, and I lead the chemical practice, and I've been on the board of Societe for a number of years. It is my great pleasure to kick off this webinar. We have two very distinguished panelists from different parts of the spectrum. On the one hand, we have Joe Danehower, he's a director of corporate development at Ingenity. And we also have Will Thorburn. He's an assistant vice president for clean tech and strategy investments for Cox Enterprises. I would try to keep the panel to about an hour. So my first thing would be to let the two speakers introduce themselves. I cannot make justice to their achievements. And really, we would like to deal with today with sustainable investing in chemicals. So from trends, opportunities, and the like. We're going to have some time at the end for questions and answers. And I would start with Joe to introduce himself, Will, and then we'll kick it off. Go ahead.
Great. Thank you, Federico. A little bit about my background. So I actually started my career as an engineer. And after a few years of that, I had an opportunity to transition to the finance and strategy world. I worked with a consulting firm primarily across industrials and consumer goods. Leaving consulting, I then joined Ingenity, working both within M&A and investor relations. I'm now back at Ingenity after about a year spent with Genomatica. Genomatica is a biotech company working in developing sustainable materials and alternative routes to different chemistries. So now currently back at Ingenity, as Federico said, Director of Corporate Development there. If you're unfamiliar with Ingenity, it's a publicly traded specialty chemical and materials company with over 100-year history of developing solutions primarily renewably sourced for customers across primarily industrial markets. One of the key and core legacy businesses specializes in chemistries derived from crude tall oil, which is a renewable feedstock, comes from pine trees. Another side of our business with a sustainable history is our activated carbon business or performance materials. That's taking hardwood sawdust and chemically activating that. And that primarily serves in gasoline vapor emissions control applications within autos. So two of our core businesses have a sustainable history. And so that of course is a lot of where we spend our time today in my current role.
Thank you, Joe. Will?
Joe, thanks, and good to see you in person. Good to see you as always,
absolutely.
Federico. So hey everyone, my name is Will Thorburn. I lead Cox Enterprises clean tech team. My professional background is some mix of M&A and strategy work. Started my career doing sell side M&A, and then was not realized quickly I was not going to be a successful investment banker, and so I joined the strategy team at Cox Communications in Atlanta, actually during a very interesting period of time when we were seeing a lot of upheaval in cable telecom related to over-the-top video streaming. So interesting time. Cox Enterprises is a big, diversified, family-owned company. And as a result of my time in our cable business, I had the opportunity to join our clean tech team in its early days in 2017. And the mission we have within Cox Clean Tech is really actually pretty straightforward. My mandate is to invest in and build and operate for-profit businesses that have some sort of significant positive environmental impact, whether that be across waste, water, carbon. Those are the areas that we tend to focus on. And we can talk about sort of our investments that sort of intersect with the chemical space as well. I'm sure we will. Maybe just a little bit more on Cox. I think I mentioned 125 years old, family owned, 23 billion in revenue, private company, two major operating divisions, cable and automotive. Within the automotive division, we own Auto Trader, Kelley Blue Book. We own Mannheim Auto Auctions, which is the biggest auto auctions business in the world. And then we have a big diversification investing effort with what I would call sort of a host of smaller businesses and or not 100% owned businesses in areas that we have some purpose or passion around. So we focus on new media. We own Axios, for instance, which is a business we acquired a couple of years ago. Clean tech, the team that I lead, we've got efforts in ed tech, healthcare, local government, software solutions, and esports, to name a few. So, a lot of people don't know that about us, but we are pretty deliberate buy-side investors with a long-term horizon. So I'll pause there.
Well, as you can see, there are very interesting parts to what you contribute to this webinar, coming from a corporate setting, and in fact, in more than one corporation for Joe, coming from a diversification mode, but a financial, position, which is what Cox Enterprises sees this as a diversification opportunity and growth and the like.
Yep.
Maybe the first question would be what kind of impact do you feel that sustainability and the raising importance of sustainability, ESG, and other concerns has had on the definition of your priorities and strategy? Maybe I can start with Will, because obviously this is diversification mode for you, and what are the parameters and how did you look at this?
Yeah, sustainability and the need for it is that's the driving feature of frankly my job. We the family that owns this business is one that's been at the forefront of conservation and sustainability for a long time. So, there's no doubt a trend. It's a beneficial trend and a real one and substantial in size towards sustainability today. But I'm sort of often proud to tell the story because we were, when I say we, I mean sort of the company and also the owners of the company were engaging in and investing in sustainability in the 90s. We had carbon neutrality goals in 2007 for all of our businesses, zero waste goals, water neutrality. And I think it's really that sort of lineage and effort that, combined with this desire to diversify and create new pockets of growth that led us to say, well, hey, why would we not create revenue and EBITDA growth in sustainable business models, which aligns with our passion, but also taps into this massive mega trend. And if if you have the generational lens that we do, I think we're fortunate to have. I would have a hard time making an argument that there's a bigger generational trend right now than the one towards clean tech and sustainability.
So this is really taking a long-term view for you, as when you say generational trend, it is not something that is a short-term, but is long-term and
very much
really
so.
Broader.
Yeah, our shortest hold right now in our operating divisions is like 60 years.
Okay, thanks. Probably not as common, I would say, in the private equity world, but
a little uncommon. Yeah.
Joe, from your point of view, because a corporation has a different time frame and has different constraint, especially a public corporation as opposed to a private.
Sure. Yeah.
company.
Yeah, no, there's certainly a different consideration as a being with a public company, right, where there's near-term pressure to be showing results. I think broadly, yes, it's been a significant impact. Not only is the growing mega trends around sustainability adding criteria to individual investment decisions, but it's certainly shifting the market and the value chains as a whole. We're a specialty chemical company, specialty materials. You think about anyone else who historically has been producing a good or a product, if any of those things have primarily been coming from the petro value chain, there's all of a sudden now pressure and even risk to continuity of business going into the future. Whether that's continual shift in consumer demand or whether that is regulatory changes, all those things are currently in play and gaining momentum. And that in a lot of ways it could even begin to change what some of these very embedded and very long value chains look like, going from a base raw material all the way up into a finished good. And so we're certainly seeing that across our business, and at the same time, I think it also presents opportunities. Ingevity for decades has been selling a number of renewably sourced products, and for a while, if you think about how those products would compete in the marketplace, it's off of the quality of the product and what application that product is serving in and price. Now all of a sudden you're adding another criteria, and I think it's still up for debate how many markets are going to value the sustainability of a product and not even just value it, but what they consider truly to be sustainable. I think we're getting closer to a more defined definition of that, and it could be things across, whether is truly renewably sourced, whether it's biodegradable, what is the true, carbon impact of that versus an alternative. I think we're moving in the right directions towards defining what those things are. And then secondary to that, I think it's, how those things will be valued, whether because of a regulatory mandate that either taxes or subsidizes a certain good over another. And then I think even further beyond that is, will a consumer and end user be willing to pay more for something that has those environmental benefits versus the alternatives that are in the marketplace today? And so I think those are all things and parts of the conversation now. And we're certainly spending a lot of time within the spaces we play today and adjacent to us as we think through where as a company we go next.
Well, this actually is a good lead into trying to be a little more specific. I mean, what are the areas that you guys have identified as top priorities? Obviously, this doesn't mean that it's good for everybody. It's probably good for you. So, and what are the parameters that that you have determined, like size or geography or methodologies or processes or so? Maybe Joe, do you want to continue on this, and then I'll have Will chime in?
Yeah, sure. And I guess to use an example to hopefully help with some of that specificity. So as I mentioned, one of our key businesses and segments today, Performance Materials, that historically is selling activated carbon for automotive emissions capture and control. Obviously, that business for many decades was on the right side of sustainability. As we are now looking at an increasingly electrified and EV world, if there are less gas consuming vehicles on the road, you could see that as a potential headwind to that business. One of the things that Ingenity, an area we invested in with our investment with Nexeon in partnership with them, is now looking at other ways that what we make today can participate in that EV value chain. And even more broadly, from a strategic standpoint, things not just EVs, but things kind of along the energy transition horizon, and what we might find there. And whether it's things we've been making today and we're able to either improve or modify product that is able to then also serve and have a use case in these new and growing markets, but also then looking adjacent to where we've participated, and do we have, we think a lot about operational leverage, where we have the right to play, what our expertise is, what our commercial relationships look like, and are there ways that we can leverage that to then participate in these new markets as they're growing. So that would be one example for us. I think another, our performance chemicals business, that's crude tall oil and then derivatives and products derived from that. We're also currently in transitioning one of our assets to run other oleochemical feedstocks, so things like soy oil and canola oil, to name a few. And I think there it's okay if we have a legacy of working with these renewably sourced feedstocks, these renewable oils. There's a lot of expertise and know-how in those spaces, and a lot of years of application development. And so it's looking at something like that and saying, okay, how do we then go and take what we do well today and leverage that, maybe with a different renewable feed source, and how do we then, look to see where that can expand where we play in the market today. So those would be a few examples.
Yeah, I mean, maybe I guess on the Kako side, so I had the great luxury of not being a clean tech or sustainability expert when I started doing this work. And so our team, we spent about a year in 2017, 2018, just kind of saying where ought we, spend time. And it was really a strategy exercise. And in that effort, we developed a handful of investment themes that I can briefly touch on. And since then have deployed, in the neighborhood of $1 billion against those themes. A major one for us is controlled environment agriculture. That's an area where we think there's enormous potential for positive environmental impact, human health impact, and a lot of opportunity for economic growth. And we own a company called Bright Farms and are a control investor in a company called Mucci Farms, growing indoor leafy greens and vine crops across North America. We have a handful of themes focused on energy. We think about renewables quite a bit, and we haven't found the right deal yet, although I hope that we're close. But specifically an interest in solar development and asset ownership. We like energy efficiency. We think there's a lot of opportunity there to both create ballast cash flow profile out of a business, but also huge carbon impact associated with emissions in the built environment. And then the area where I probably spend the most time and have the most sort of personal passion, but also is like the earliest stage and maybe riskier in some respects and some of those other ones I mentioned, is circularity. And we've done a good deal of investing in and around technologies to take waste streams and convert them into something of value. And internally, I call this waste to X. Externally, I call it circularity, which is much more elegant. And so, we sort of built ground up a tire pyrolysis plant in South Georgia in the States to process tires coming out of our auto auctions. We are an investor alongside Breakthrough Energy Ventures and Sierra Energy, which is a municipal solid waste gasification technology business in California. And then we are a control investor in a company called Nexus Circular, which takes film plastics, converts them into circular feedstocks to put back into the plastics manufacturing supply chain. And I think, that's really, it's that sector and those businesses that have given me a lens into the potential, both for environmental impact, but also genuinely for a lot of sort of value growth in and around what I would call green chemicals. And it's some mix of dealing with the waste streams and scaling new tech, and then sort of supply chain replacement with renewables. There are more areas in which we focus. We invest across the spectrum from Series A all the way through buyout. Pretty flexible in that regard, and maniacally focused on balancing impact with sort of the economic fundamentals.
How do you source these things? So some of them are closer to where you are. Like if you have to recycle tires from your tires auction, that's you have a supply there.
Yeah.
But how do you go about sourcing them? Do you seek them out? Do you have people coming to you? Do you go to fairs? Or what are the parameters?
Do you mean in sourcing, Federico? Do you mean deals or feedstock?
Deals, ideas, or investments, or whatever.
Man, that's a good question. I mean, we've got a team of really smart people who do a bunch of great desktop research and read and consume everything they can about clean tech markets broadly. And then, we spend time telling our story and building relationships with investors, companies, investment bankers, management teams, corporates. And a lot of my job is evangelizing our mission. And we try to approach these markets with some measure of humility, understanding that we don't know everything, and that fundamentally we're investing in change and disruption, and we're there to learn. And so, that's really the approach we take. But I would say that from a tactical standpoint, for us to transact, we need to build a good deal of sort of strategic conviction internally. And so there's some triangulation between acknowledgement of opportunities in the market, what we're learning about the sector and space and companies. And we kind of try to graduate through these stages, both from an opportunity standpoint, but also from a strategy standpoint, such that we're building the requisite conviction and excitement within our four walls to transact. Because as I mentioned, with a long-term horizon, we are very deliberate from a team and sector standpoint, and so we try to take our time as well.
Do you have any hurdle rates or IRRs or requirements that you have, or?
Yeah. I mean, but the truth is, it's a bit fungible. So we are probably less. I don't want to give the indication that we're not rigorous on sort of economic or impact, but we're really we're triangulating between what we believe the long-term opportunity to be. So let's say 5 to 15-year opportunity, or potentially beyond, what we think the environmental opportunity can be, where we think we can add strategic value. So with a big operating platform, frequently we can identify opportunities to bring value to companies we invest in through relationships or capabilities that we might have. And we're sort of balancing this stuff together to try to get to the answer. And so, I think, like, if there was, let's put it this way, if we had a hurdle rate for a particular stage of company at 15%, but we thought a business had great long-term potential and could have a really meaningful environmental impact, and we could only underwrite it to 13%, we might still do that deal because of the value of some of these other factors that are important to us. But we certainly have targets that we're trying to achieve.
And Joe, similar question to you. How do you source? How do you value? And to what extent being a public company colors your willingness to invest and your timing and the like?
Yeah, sure. So yeah, I'd say sourcing, there are a few different probably primary avenues. One would be, our relationship with investment bankers and other firms and funds that are out in that space, and really cultivating those relationships and making sure that we're out there, we're speaking with people, we're learning as much as we can. The other, we're starting to, and we're working on this to even improve, but starting to get more and more inbound coming from our commercial teams, and setting them up to have eyes for what they think is interesting in the marketplace, to be asking what customers are looking for, where they're having specific challenges. And then, ultimately, within the scope of this conversation around sustainability, we're asking where sustainability is important to them and what they would either like from us, or, who has offerings out there in the market that they, think are meeting those needs and those demands that they're seeing and they're experiencing. And I think the other, we'll kind of mention desktop research. I think that's also becoming increasingly important for us, especially as we're looking at things that are outside of what we've done historically. And we have a team here that spends a lot of time, staying up to date on news, reading about where money's going, what different funds that are playing in the climate tech space or energy transition space, where what they are seeing as attractive and valuable. And so those are all things that kind of feed into that idea generation and what ends up on our pipeline. In terms of investment criteria, certainly as a public company, we have our own internal metrics and hurdles. And again, as a public company, we have the quarterly pressure to report earnings, report what we've done with our cash. And so there certainly is some good rigor there. I think along with that, though, for some of these newer opportunities, growth areas, where we've made investments in earlier stage companies, we, much like Will said, we are looking at a longer time horizon, and we're weighing that heavily with the strategic rationale of making such a decision. And if it's something that we believe could build into a platform that offers future growth along with that sustainability profile, those are things that then we're weighing against any of the financial metrics or criteria as we're making investment decisions.
And I think,
go ahead.
Sorry, Federico, really quick, to that point that Joe's making, it's an interesting one, and it's one that I think the entire universe of sustainability-minded investors, there's this bucket of folks deploying capital who are not, they're not nonprofits, but they're not sort of the traditional KKR model. It's something in between. And time horizons associated with, in particular, earlier stage clean tech companies can extend beyond like a traditional fund window. certainly beyond, I imagine, Joe, like, public company, typical time horizons for sort of accretion. But the thematic area is important to customers and investors and those in your supply chain, I imagine, certainly that way for us, and to sort of more direct stakeholders. And so there's a little bit of a tension there, but it does feel like, and I think illustrated by what you're saying, Joe, markets are rewarding some amount of strategic effort focused on longer term opportunity there.
Right. And I think some of that reward even comes to, what I would call, I mean, I think in a lot of ways it's risk to supply chain. If you're not doing something now, eventually you may have a product that someone says you can't make or sell anymore, or no one will buy anymore.
Yeah,
And
regulatory threat. Yeah.
Yes. And if you're not ahead of that, that presents a significant cliff to whatever your existing business is. And I think, investors want to see that you're thinking ahead, and that you're not waiting until the problem comes, but you're seeing that it could be, and you're being proactive about it, and where you're spending your time and deploying capital.
One of the things that some companies that we have noticed is that they actually have a dedicated venture fund that they do, and that kind of is separated from some of the parameters that color investments by corporations. For instance, they would just make more like a portfolio approach, because some technology may work, some may not work. They make minority investments. They don't do control investment. In your case, obviously you may have a different view. Are you willing to be flexible in the type and size and control and governance and exit in your strategy, Joe?
Yes. Yeah. So we don't have a dedicated venture group. We have made a number of venture investments, and as we set up to start doing some of that, we certainly set up an individual process and a set of criteria that is, there's certainly crossover and similarities between our traditional M&A criteria, but we've given a much more flexible lens, and frankly, we lean very heavily on the strategic merit and what that could mean for the company looking longer term. And again, it's looking at opportunities that present, either significant revenue or earnings creation, beyond maybe what is typical if we were just looking at an M&A deal, right, where you're looking for that accretion or that earnings generation, very soon and very quickly to justify the deal. On some of these venture plays we've made, we're leaning very heavily and spending a lot of time to really understand. And again, there's risks in all of that, of course, but we certainly have taken a longer lens as we've looked at those opportunities.
And this is an open question for both of you, have any of these investments that you made not worked out, or surprised you in a negative way, or needed to be restructured or reconfigured or whatever else? I mean, everybody talks about successes, but it's not always a happy story. Are there anything you care to share?
Well, Joe, do you want me to go, or do you want to go?
Yeah, I'm not sure how fulsome I can be, being that we are public. I would say yes, there have been things that have surprised us, and we've been learning as we've gone here. I would say, and I think we'll even mention this, talking about the time horizon challenge that you can have when you're looking at these earlier stage companies. If you're thinking within chemicals, if you're thinking within materials, even energy, oftentimes these opportunities require capital and steel to go into the ground. Those things are difficult, especially if it's a first of its kind asset. And I think for a lot of companies and startups and in the venture space, there's a lot of really good technology and a lot of really good lab work. I think the hard step is then going from the lab to pilot to commercial scale. And oh, by the way, say you're making a material, do you have the expertise? Do you have the partnerships to also then do application development? And I think it's that scale up piece here that is challenging, and you know, there are plenty of examples in the marketplace where you know, that's been the roadblock. I mean, the one I often think of, you know, and actually I think they were in the news yesterday, Zymergen, where, you know, really good technology, that the scale up was the hiccup. And you know, I think, you know, again, that just tends to be where a lot of the unknowns can lie. I think along with that, you know, if you're looking at a disruptive technology, it's not just, you know, disrupting their piece in the value chain. It could be disrupting the piece ahead of them or behind them. And I think, you know, I think you tend to see those hiccups and maybe a drag on timeline when there's not appropriate visibility or appropriate understanding of, you know, what's before and what's behind it, even in if it's a physical good that's being produced and made.
I think Joe said it really well. That was well articulated. We've had successes, failures, and in-betweens, and would agree that commercialization, particularly of infrastructure type tech within clean tech markets, is challenging. It's more challenging than I think lab scale development. Capital needs skyrocket, risk skyrockets. All of the sort of supply chain, value chain dynamics begin to come into play, and it's hard. I mean, it just is. I think that's, you know, one of the reasons why the rewards are great. You know, when these businesses win, I don't want to pick on any of our more challenging ones publicly, but we've certainly seen challenges. The other thing that I would just maybe mention too is we actually do have a dedicated venture fund. It's called Socium Ventures. The fund was publicly announced earlier this year, sort of came together last year. The fund does not have a clean tech specific focus, although it will do clean tech deals. And I think, you know, it's something we're quite excited about, is the ability to deploy a proper venture strategy and approach across a variety of segments where we see opportunity and have some passion. And I would expect we will continue to do sort of A/B stage clean tech deals via Socium over time, and hopefully try to take advantage of the learnings that we've had from some of the more challenging and some of the more successful investments we've made.
How big is the fund? Have you
I
announced?
don't know if the numbers, I don't know if it's public. You know, well into 9 figures. And you know, as you would imagine, long-term horizon, sort of evergreen in nature. And you might, I don't want to overstep and sharing too much, but if it's SOCIUM, and you know, you'll sort of see it out there on Google.
Well, it's a great Latin word that stands for associate and collaboration and everything else. So
yeah.
Let me move on to maybe the regulatory aspect of it, because some of the investments are this is an evolving market, right? So you actually could be investing in things that are not regulated yet, but you may want to then work with regulatory authorities or with a lobbyist or something to make sure that the investment you make fits within acceptable parameters, which are not yet developed, or they are different in Europe, for instance, than here. How does the regulatory element play in your investment decisions and in your development of your investments?
Maybe I'll start on this one. So it's a great question. It's a constant topic in sustainability investing, both opportunity and risk, so to speak. And I think, I mean, from a sort of to framework it, I try to avoid deals and sectors where there is a material sort of risk or opportunity associated with regulation that would be key to any investment decision. Meaning, I don't want to underwrite regulatory subsidy over a long period of time as a critical part of the economics in a business model. I want to think of that as sort of a cherry on top, but I think the core unit economics of the business have to stand on their own. And I also would not be excited about participating in a space where there is a clear and present threat of sort of draconian regulatory measures that could shut down a model or a sector. I think at a sort of macro level, I would expect over time deployment of and adoption of clean tech and clean tech related businesses and models and technologies is sort of going up and to the right. I think the road will be bumpy depending on, sort of who's in office at what point in time. But to some extent, it's my view that the horse has left the barn on sustainability, and we're going to see more and more of it over our lifetimes. But we don't underwrite to regulation, or we try not to.
Yeah, I would agree broadly, Will, with what you said there. And I think, yeah, underwriting to regulation is certainly a dangerous game. And frankly, it's hard to predict. And I think, it's one thing to see the headline about what a subsidy or what a tax might be, or how, a regulatory body is thinking about a specific, carbon mitigation legislation. But a lot of that can even lie in the details. And I think one example I was reading up on actually last week, you think about the hydrogen space. There's a lot of subsidy dollars that are out there that should be delivered in the U.S. to help accelerate the growth of the hydrogen economy. However, a handful of projects where they're out there saying they either want to build a electrolyzer factory or hydrogen production or whatever it might be, there's hesitation to move forward on some of these projects because the specific criteria for what will qualify for a credit versus won't has yet to be fully defined. And so even within the time frame of a specific project, again, I think subsidies and tax credits towards those types of projects is a great thing and a needed thing. How those things are being defined and when they're defined and could that definition change, those actually can present hurdles even to the timeline of what a project might be. And then all of a sudden you actually could get into a situation where you may struggle to get committed capital in the door because of that uncertainty, and it can influence the way investors who are lining up, or whether it's equity or a credit facility, that all of a sudden then needs to be diligence kind of across the board for a project to move forward and steel to start to go on the ground. And I think one of the biggest things and a benefit to the entire space would be continued clarity. And I think everyone would like to see the definitions of what these things are going to be to come out quicker than they have. That lack of clarity, I think, can hold up a lot of these things and make people hesitant to want to move forward in something, especially if it's the economics of a business, the economics of a project are entirely dependent on what government funding or subsidy might be available to them. I think the big one is, at some point in the future, is there a tax on carbon emissions? And is that something that happens first in the EU? Does that happen in the US? And then there's a lot of unknowns of, okay, if there is a carbon tax specifically, who along the value chain would get to benefit from it? And I think these are all big unknowns. And I think there's some industries, like I think of renewable natural gas as one where we've started to see a little more clarity on how that can play out. But that's taken time to develop. And, frankly, a lot of the value in the carbon credits around renewable natural gas, I mean, that's it's a lot of that's now dictated by the secondary market that took time to develop as well. And so as you see those types of, crediting systems or even, even if it turns out to be a punitive where it's, you're taxed on the tons of CO2 that you produce. I think, it's going to take time for us to see where those things shake out. And and as Will said, I think there's going to be a lot of bumps and a lot of ups and downs along the way.
Yeah. And I, you made me think of a point I probably failed to mention, Joe, but there are certain forms of regulation that are certain enough and long range enough to where they belong in the underwriting criteria. So specifically, if I think about components of the IRA tied to renewable energy generation, pretty bankable for a long period of time, but sort of comfortable with that. But I think hydrogen was the perfect example you brought up, where there's less clarity, and certainly the sort of specter of an enormous economic boon for the sector, but there's a sort of to be determined on exactly how that functions. And so if you're a project investor, perhaps you get a little clarity and you're comfortable underwriting a particular project because of the economics that you can sort of derive. But as a sort of topco platform investor with a longer horizon, we're typically looking at sort of core unit economics versus those encapsulating regulatory value. And there's always the risk, Federico, which we can talk about, or influencing too. But I don't want to volunteer a ton of time on this one if you have more questions.
No, I mean, and by the way, I encourage people, our listeners, to send me notes for question to ask. You can put it in a Q&A question. But I think one of the key points here is that we are not really just looking at things as just as an economic, purely economic return, but there are other timing issues that are impacted by regulatory. That, for instance, you enter at the right time because maybe there were subsidies for solar that expire or so. And so it depends when you invest in the silicon or the value chain. Or there is another thing, that is some of the companies that people could invest would be more in the services area. So not just manufacturing in ESG. I'll give you an example. SK Capital acquired a company called Milestone Environmental Services recently that does permanent carbon sequestration and trading of carbon. So there are things that happen, that investments are not in the manufacturing per se, but in the services around the ESG factor that are just as relevant. And they, that in this case, you see private equity groups with a shorter time frame. I love your 60 years old, kind of timetable.
Yeah, we probably, if you saw my underwriting models, they're not 60-year models, but
I would hope so, but I'm very impressed by that. I mean, it's beyond the Warren Buffett investment criteria, so it's very interesting. As we move on to something else, is to what extent the current environment, the interest rate up, going up, and maybe the economy or so, have played an impact on your investment criteria? Because obviously the situation today is different than a few years ago, and people are more concerned about the economy today or so, the political aspects. To what extent you see these playing a role in your investment decisions?
Joe, do you want to start on this one, or you want me to?
Yeah, I mean, I would say, I mean, for us, as a public company, it's probably what you would expect, right? I mean, you can go and calculate our WACC if you want, and can see over time how that might change if our capital base did. But yeah, I mean, I certainly think it tightens returns across projects, and again, it all depends on how that is funded. I think it's made people hesitate across the space in general. However, I don't think it changes anything about long-term conviction or long-term strategy. It may make, I think you're actually already seeing this in the M&A space, even outside of sustainability. I think it's forcing more creativity on how deals are structured. I think that creativity and flexibility is how you still continue to invest and invest successfully in a higher rate environment.
Yeah, I would say, I mean, there are, of course, challenges associated with the rate environment that we sort of experience across our operating divisions. But if I take sort of the lens of not the broader Cox Enterprises lens, but let's say the Cox Clean Tech lens, I would say that today we are in an environment that is substantially more favorable on the buy side for a strategic like us with our sort of mandate and investment horizon than the environment we were in 2 years ago. And so, we are not a near-term arbitrage type investor. So I don't think, you would see us behaving really any differently today than we would a couple of years ago. But I do see more deals getting deeper in our pipeline simply because of things like that, somewhat normalization of valuation expectations. Now that we're sort of through the SPAC thing, and so I relate some of that to the broader macro environment. So we try to be sort of steady as she goes, regardless of the economic environment. But of course, we have to sort of pay attention to what our divisions are doing, and we're balance sheet investors, and so could be impacts.
I have a question from Joe Chang for Will. What made the Nexus Circular attractive enough to take a majority stake versus other plastic recycling companies?
Yeah, that's a good question.
Have you looked at other opportunities? Are these becoming ironically cheaper given difficult financing? Because they look at somebody like you who is good for the money and good for subsequent investments, I guess. But Go ahead.
Yeah. No, we've looked at a bunch of them. We sort of got into Nexus very early stage. I mean, this is one of the benefits of being sort of nimble and private. And so we were sort of first money in the business to build a commercial demonstration. And so we were an investor in 2015. And at the time, we didn't have a clean tech team, and we did not have sort of a sector perspective on circularity, but we did have the sort of conservation-minded passion that I was sort of articulating earlier. And fast forward a couple of years, and we start working on clean tech, and I'm building a sort of a perspective on circularity, and realize we may have one or two sector-related investments in our portfolio already. And we were able to take a slow, the Nexus leadership team would kill me if they heard that. I hope none of them are on here. But we were able to take a deliberate path towards commercializing the business, meaning Cox was okay bridging capital here and there. We need another $2 million because a component of the tech development took longer than we thought. Is it working? Are we making progress? Do we believe that the market continues to develop? Are we seeing the indications on the Cox side that we would need to believe that this is a commercially viable business? Yes. And not only yes, things were sort of getting better along the way. So sure, let's bridge. And we did several bridge rounds between 2015 and 2020. In 2021, I, along with some of our executive leadership, made the determination that we believe the company was commercially viable based on the performance of the technology that we were seeing. And we put together a $30 million round. And we brought in a little bit of outside capital, and then and sort of built out the project development organization, continued to improve the tech, built out the team, and then raised a much more significant round, $150 million of capital in 2022 to build our first scaled commercial plant. an effort which we're sort of underway on. And so to answer the question, hopefully I'm answering the question, but we were deliberate, and we were milestone focused along the way, and we kept the North Star in our mind versus sort of the day to day, because it's a bumpy process. I mean, it's hard, and pyrolysis is not hard in a lab. It's real hard with heterogeneous feedstock that's got different levels of moisture and contaminants in it to create a consistent product. And
which is why it's a problem scaling it up. I mean, you can have a pilot plant that works, but then we have a real
and so we spent 6 or 7 years really running a piece of technology. I mean, that's kind of what we were doing, and we'd break it and then we'd fix it, and we'd break it and we'd fix it. And we had that, we were fortunate to be able to do it that way. I've looked at many of the other businesses in the space. There are some super impressive other players out there, and I take a collaborative approach towards the ecosystem. I think we need to be in a rising tide lifts all ships mentality now, and we can have fights over market share in 2035. But there's a lot of pie to go around right now, and we want to see that space be successful, both for Nexus, but also just for the environmental benefit associated with it.
Joe, any comment on this? We have to wrap up soon, but I just wanted to give you the floor.
No, thanks for sharing that. I think that detail is a good case study and indicative, I think, of what a lot of these newer technologies, disruptors are looking to do, and the hurdles along the way. And I think you're 100% right. If you have investors and partners that are willing to work through those challenges as you go to scale, I think that's what's necessary to get these new technologies, new value chains off the ground. And so I think what you're doing, and you're doing it the right way. So appreciated you sharing that.
Happy to, and likewise.
But look, I think we are at the end of our hour, and we try to keep to the time. I wanted to first, if there is any final comment that you, Will, or Joe want to make. Just wanted to make sure that this is being recorded for posterity. So you're welcome to make it if you want.
I would just say thank you everybody for having me, and I enjoyed it. Federico, always great to see you, and we're always here at Cox and very partnership minded. So feel free to reach out anytime.
Yeah, and likewise, enjoyed the chat today. Thank you, Federico, for organizing, and Will for your insightful comments throughout, and everyone who attended. And feel free to reach out to us here at Ingenity.
Well, I wanted to thank you both for participating, and I encourage everybody to join Societe. It's www.societe.org. As a member, you can have replay of this webinar and all of the other prior ones. And if you just go online, you can see the other events, starting with the happy hour tomorrow. But thank you very much, and look forward to seeing you all soon. Thanks.
Bye, everyone.
Thank you.